Welcome to The Economist in Your Ear. Today we're looking at something that's really caused a stir in Britain, the government's brand new industrial strategy. Now, The Economist had a pretty sharp take on this recently. They used this colorful analogy of a party boat crammed with lobbyists, suggesting, maybe it's more about appearances than real economic impact. But is that the whole picture? We're going to try and pull back the curtain a bit, see if this strategy is, dead in the water, or if there's actually something more substantial going on.
It's a great image, that party boat, and The Economist certainly made some strong initial points, very sharp critique. But, with these big policy documents, these economic plans, what you see on the surface, it's really the full story, is it? So today, our aim is really to unpack that analysis, see where they really hit the nail on the head, but also maybe where they didn't quite get the full picture or where things have, moved on since. We want to give you that rounded view, really get past the headlines and understand what this actually means for the UK economy going forward.
Okay, let's really get into it then. The Economist's main arguments, they were pretty direct, weren't they? What were the immediate sort of red flags for them in this big 160-page plan?
Well, one of the biggest ones, and it's a fair point, I think, was what they called the funding gap versus ambition. You see the headline number, an extra £15 billion over 5 years. Sounds like a lot, right? But when you actually break it down, it works out to just 0.1% of GDP each year, which is, tiny.
Tiny compared to what they want to achieve. Or tiny compared to other countries.
Both, really. I mean, compare it to something like the U.S. Inflation Reduction Act, the IRA. That's a completely different scale of investment. So the idea that this relatively modest sum can genuinely catalyze hundreds of billions in private money, The Economist saw that as optimistic. It looks a bit like wishful thinking, perhaps.
Okay, so the money's one thing. What about other areas? The Economist seemed to think there was a bit of a blind spot around skills, universities maybe.
Exactly. Yeah, they flagged that. The strategy mentions a global talent task force, which sounds good. But The Economist pointed out, quite rightly, I think, that it kind of sidesteps the deeper financial problems facing UK research universities right now. And the money for this task force, $54 million.
Yeah.
It's mostly for admin, using existing visa routes. It doesn't really tackle those big systemic funding issues.
So not really getting to the root of the problem there.
That was their take, yes. It felt a bit like tinkering around the edges rather than addressing the core challenge.
Yeah, and there's that classic criticism, the one that always comes up with these strategies, the pick and mix grant culture. That smorgasbord of small pots.
Yes, the smorgasbord. That's where the party boat image really comes in, doesn't it?
Yeah, you can picture everyone jostling for a small piece.
Yeah, precisely. And The Economist highlighted this. They listed examples. 18 million here for clean energy in Felixstowe, 9.7 million there for battery training in Newcastle, 150 million for creative industries. The argument isn't just that the pots are small, it's that this fragmented approach can be inefficient. It encourages lobbying, might lack strategic focus. And historically, these kinds of schemes haven't always done much to significantly boost overall productivity. That's a valid concern based on past experience.
Okay, but one area The Economist did seem to give some credit for was tackling industrial electricity costs.
Yeah.
It's a huge issue for businesses, right?
Absolutely. Businesses have been complaining about high energy costs for years. It's a genuine competitive disadvantage. So The Economist acknowledged that taking tangible action here was positive, but they also flagged a big unknown: who is actually going to pay for this relief? That was left unclear in the initial plan.
Right, the unclear funding.
Yeah.
But you mentioned things have moved on.
Yes, and this is where we can add some important new detail that wasn't available when The Economist first published. We now have more clarity on that power price relief. From 2027, a new scheme is set to cut bills by about £40 per megawatt hour. That's roughly a 25% cut for around 7,000 energy-intensive businesses. It's quite significant.
Okay, that's substantial. So the who pays question, has that been answered now? How's it being funded?
It has. The plan is to fund it through a mix of higher revenues from the UK's emissions trading scheme options, that's the carbon market, and also a levy on general energy bills, though the details of that levy are still a bit fuzzy.
So it clarifies the mechanism, but throws up another debate immediately, doesn't it?
Exactly. You solve one problem, but raise questions elsewhere. It brings back that whole discussion about, should general consumers subsidize heavy industry versus using those ETS revenues, say, for broader grid decarbonization. It's a debate about where the burden falls, essentially.
Interesting. Now, another point The Economist made was that the strategy targets 1/3 of the economy. How does that figure stack up when you dig a bit deeper?
That's another area where looking closer adds nuance. So yes, the 8 sectors chosen, like advanced manufacturing, life sciences, creative industries, finance, etc., they do account for about a third of the economy if you measure by gross value added, or GVA.
Which sounds a bit arbitrary on its own.
It could seem that way. But here's the key thing. Those same sectors account for roughly half of all UK business R&D spending, and about 2/3 of high-value exports. So when you look at it through that lens, R&D intensity, export potential, the focus looks much more strategic. It's not just about size, it's targeting areas where the UK arguably already has strengths or potential high growth.
Okay, so it's less about picking a random third, more about doubling down on areas with existing clout.
Precisely. It suggests a rationale based on comparative advantage, not just sheer economic footprint.
And going back to that global talent task force, the economists sounded quite dismissive, calling it perhaps token. You mentioned the funding was small, but is there more to it?
Well, again, context is key. While $54 million isn't a huge sum overall, the new detail is that it's specifically ring-fenced for relocation and startup costs for top international researchers. This addresses a very specific practical barrier that universities themselves said was a problem, those initial moving and settling in expenses for talent. So it's designed as a targeted tool to help attract specific people, complementing the main visa system, not replacing it. It's maybe less token and more niche or targeted.
A specific solution for a specific problem, then.
You could see it that way, yes.
And the electricity relief, the economists sort of implied it was mainly for older industries, steel, ceramics, that kind of thing. Is that the whole story?
Not quite, no. While those traditional energy-intensive sectors definitely benefit and lobbied hard, analysts are pointing out that investors in things like data centers, battery gigafactories, semiconductor plants, these were also pushing hard for these energy cost cuts.
Ah, so the newer high-tech sectors, too.
Exactly, which suggests this relief isn't just about supporting legacy industries. It could actually be crucial in attracting new investment in advanced manufacturing and digital infrastructure. It shapes the landscape for future industries, not just propping up the past.
Okay, so bringing in those updates definitely adds important layers to the economist's initial take. Let's head back a bit now. Even with the original information, were there maybe some underlying assumptions in their critique that are worth, probing a little?
I think so. One key assumption seemed to be that industrial strategy inevitably means just a smorgasbord of pots. Focusing heavily on the individual grants, the small amounts, might risk missing the bigger picture or the overall signaling effect the strategy is trying to achieve. It kind of frames the whole thing through that one, perhaps limited lens.
Right, seeing the trees but maybe not the forest.
Something like that, yeah. And another assumption seemed to be that crucial things like planning reform or tax changes are totally outside the scope of the strategy document itself.
Which feels a bit artificial. Surely they're connected.
They have to be, right? While the document might not contain new laws on planning, major industry groups like the CBI and Make UK are saying very clearly that the strategy needs bolder planning, tax, and skills reforms alongside it to actually work, to be investable, as they put it. So these things aren't really outside the scope in practice. They're essential conditions for the strategy's success, even if they're handled through different policy channels.
Okay. And we touched on this, but the assumption that high electricity costs only really hurt old industries.
Yes, and as we discussed, the reality seems broader. It affects the viability of data centers needed for AI, advanced manufacturing. Essentially, high energy costs are a drag on the future economy the UK wants to build, not just the past.
Makes sense. And finally, maybe the implicit idea that small pots always equal low payoff. Is that automatically true?
It's a tempting conclusion based on history, certainly. Lots of small schemes have fizzled out, but this strategy is trying to target sectors with existing strengths. So the argument could be made that even small pots, if targeted very specifically at high potential niches within those strong sectors, might have a catalytic effect. It's not guaranteed, but maybe it's not automatically doomed either. It depends on how targeted they are.
So maybe thinking about it differently. Not as a massive state intervention, but something else.
Exactly. An alternative way to look at this whole thing is perhaps as industrial policy light. It's clearly not the huge state-led transformations you see elsewhere, but it does have some potentially interesting features.
Industrial policy lead, I like that framing. So from that angle, what would its strengths be? What makes it elite but potentially still effective?
Well, first, as we said, it does try to pinpoint sectors where the UK genuinely has a global edge: life sciences, fintech, creative industries. It's building on strengths, not trying to create them from nothing or protect failing ones. That feels more realistic. Second, it tackles a real, concrete cost issue head on electricity prices. That's a practical step businesses appreciate. And third, critically, it sets out a 10-year time frame. Business groups constantly ask for that kind of long-term certainty. It signals stability, which is vital for investment.
Okay, those sound like tangible plus points. But lite usually means compromises, too. What are the limitations or downsides of this lite approach?
Absolutely, there are downsides. The big one is that it leaves some major roadblocks largely untouched: complex planning rules, issues around capital investment allowances, the financial health of universities. These core blockers aren't really fixed by this strategy alone. Also, the fix for electricity costs involves shifting costs onto other consumers via levies, which could distort market signals needed for decarbonization. That's a tricky trade-off. And that 10-year horizon, it's good signaling, but without long-term funding guarantees locked in across parliaments, it's still vulnerable to changes in government spending priorities down the line. Its durability is still a question mark.
So pulling all this together, where does it leave us regarding Britain's economic prospects? The Economist's core point still stands, maybe, that this strategy alone won't be transformative.
I think fundamentally, yes, The Economist is right on that. This strategy by itself isn't likely to dramatically change the UK's productivity path overnight. It's not that silver bullet.
But as we've explored, it seems to be doing a bit more than just, scattering some money around. It addresses a real cost, focuses on strengths, acknowledges talent. It feels like there's some substance there, even if it's lite.
There is, and the real tests are still to come. It's less about the document itself now and more about the follow-through. What you really need to watch for going forward are three things. First, does concrete action on planning and tax reform actually materialize? Perhaps this autumn. Without that, private investment might remain hesitant.
Right, the enabling conditions.
Exactly. Second, how transparent and sustainable is the funding for that power price cut? We need clarity on how those costs are managed so they don't just create problems elsewhere for other businesses or households. And third, will the new innovation hubs and centers created by this strategy get stable, multi-year funding? Or will we see the old UK pattern of stop-start initiatives that undermine long-term confidence?
That long-term stability is crucial, isn't it?
Yeah. It really is. Without that kind of follow-through on all fronts, the strategy does risk ending up like that party boat. The Economist described looking busy, lots of hopeful people on board, but ultimately not really going anywhere. It's a plan with potential, but its real impact depends entirely on the actions that haven't been taken yet.
A compelling vision, perhaps, but success hinges on the next steps. Definitely lots to keep an eye on there. Thanks for joining us for this in-depth look.